The purpose of this presentation is to focus on how business leaders look at risk, loss, and the cost of security programs. All too often, as security directors, we have to prove the value of the absence of problems and are often confronted with business people who are skeptical as to whether our programs represent real value. In this presentation, we will cover fixed costs for security programs versus variable costs. For example, losses due to fraud, theft, counterfeiting, and other crimes against the company. Our goals are to discuss how to develop and manage security programs that enhance profitability, how to make the company a tougher competitor, how to enhance the company's ability to reduce shrinkage and losses, how to reduce attrition of employees, especially those who should not have been hired in the first place, and finally to create a safer and more efficient workplace in order to promote productivity. For the security professional, perspective is critical in working in companies. One of the clear difficulties in understanding the cost of security is the continued lack of standards and metrics in our profession. Benchmarking, comparative analysis, and best practices still lag behind many other professions. In working with internal customers and management, it becomes critical to provide the highest degree of conformity to known standards. In areas where standards are weak or non-existent, then you should move to benchmarking to both manage and explain security business practices. Outsourcing has obvious security cost implications both on the variable cost side as well as on the fixed cost side. An important issue to keep in mind is that the majority of companies outsource to reduce cost. Reducing cost does not mean reducing security and increasing risk. The programs managed by the security director can be proactive in making sure that the burden of security is identified and that the outsourced party is held responsible. Remember, if your outsourced provider allows your company to be defrauded without risk of significant penalty, then it is only a matter of time before you are a victim. This presentation will devote a fair amount of time to types of cost. Business people are great at focusing on fixed cost because they are predictable and can be readily managed. Variable costs are somewhat different and in some cases can be significantly different. Failure to understand variable costs related to security can be expensive and have a significant impact on brand and reputation. Variable costs due to fraud, internal and external theft, counterfeiting, diversion are often viewed as one-offs, which are not budgeted for. Security programs, on the other hand, are fixed cost programs which can be easily cut to achieve budget goals, while the variable loss can be blamed as the problem. Several years ago, Visa reported that a full year of charges exceeded $1 trillion. Historical data reflects that fraud as a percentage of sales averages around 0.1%. The cost to consumers and to banks amounts to billions of dollars. The critical issue here is a matrix involving measuring the fraud losses to charge volume and controlling increases in fraud losses by increasing security mitigation strategies. It may seem that 0.1% is a small amount, unless, of course, the amount is as significant as our example. So first, ask yourself, what do we lose at our company compared to what we produce or sell in terms of services or goods? As the company gains scale, insignificant past losses can suddenly become significant, especially to profitability. In 2005, Card Systems Solutions in Tucson, Arizona, a third-party processor of payment data, called in the FBI to investigate a potential security incident involving information on 40 million credit cards. The possible threat of the loss of card member data seriously eroded the relationship between the company and major credit card issuers. Today, the company has been sold and merged into another company. Furthermore, today, Visa and MasterCard have issued strict information security programs with increased costs to banks and merchants in order to better control the risk of compromise of card member data. The obligation of a good security department is to advise management of ongoing risk, not as scare tactics, but as business issues. For example, in 2003, the Gartner Group reported laptop thefts totaled 600,000 in the U.S. Issues included not only the cost of the laptop computer, but the proprietary information that was on it. Interestingly, Gartner also reported that 80% of the laptop thefts were recorded as internal thefts. Theft of customer and company information often is much more serious than the loss of the laptop.